have it once a month, and it's an educational series that we have for our businesses to discuss programs and incentives. We bring experts in to talk to you guys about ways to help your business conserve, save money, reduce greenhouse gas emissions, address waste, and engage employees. And we are so excited this morning to have the experts that we have speaking to you, really from all across the country. And I'll talk a little bit more about them in a few minutes. Just a few items before we begin, a few housekeeping items. Presentations will be available after today at fcgov.com/BizEd. For those of you logging in on WebEx, please mute your phones if you don't mind. Questions can be submitted throughout the presentation on Twitter, and there you can see the link to that, and then also on Facebook. You could submit them on WebEx, and here in the room you can actually put it on the Post-it notes, and we'll collect those throughout. So just wanted to promote our upcoming BizEd programs. We have the next one, July 17th, Managing Stormwater Naturally. And I don't have to read the rest of those off to you. You can see what we're offering. But again, just feel free to check in on fcgov.com/BizEd for more information about those programs and to register. So I am really excited to present who you'll be hearing from this morning. So the first speaker we have is Christopher Russell. He's with Energy Pathfinder Management Consulting. Christopher is a nationally recognized expert in the planning, justification, and evaluation of business sector energy cost control initiatives. He's a visiting fellow with the American Council for an Energy Efficient Economy in Washington, D.C. He's served as the politically appointed energy manager for the Howard County, Maryland government, and he has documented and evaluated energy management practices at dozens of facilities and has advised corporations, utilities, trade associations, and government agencies in the planning and promotion of industrial energy programs. He holds an MBA and a Master of Arts from the University of Maryland and a Bachelor of Arts from McGill University of Canada. If you'd like to find out more information about Christopher, you can go to his website, which is www.energypathfinder.com. So that's our first speaker, Christopher. Our second speaker is Kimberly Merrill, and we're lucky enough to actually have her here. So she is with Energy Engineered Tax Services. She is the Senior Vice President of ETS and has been an entrepreneur for more than 20 years since she began operating numerous successful companies that specialize in energy efficient products. Since working with ETS, Kimberly has personally secured millions of dollars in tax incentives for Fortune 100 companies, architects, and CPA firms across the country. Because her attention to detail and passion for success is paramount, she has the ability to recognize regularly missed opportunities, and her project management skills are unmatched, and her client relationships reflect this. So we're really excited to have Kimberly here. And then our last speaker will be Matthew H. Brown. Again, we're lucky to have him here, and he is principal of Harcourt, Brown, and Carey Energy and Finance, and has worked in the energy, finance, and policy field for more than 20 years. His work has spanned research on viability of clean coal companies, establishing public-private partnerships for the financing of natural gas fueling stations. He directed a program on a wide variety of state clean energy policies and has testified in more than 35 state legislatures, as well as in front of the Federal Energy Regulatory Commission. His work has taken him from New York to Colorado to Paris. Since his return to Colorado, Matthew has built upon his background in a combination of clean energy policy and finance to develop an extensive practice that involves assisting state governments, utilities, lenders, the U.S. Department of Energy, national associations, and other areas in the area of clean energy finance. So if that doesn't impress you about these speakers, I don't know what will. We're so lucky to have them here today and for you all to be able to listen in. So with that, I am going to turn it over to Mr. Russell.
Again, folks, the takeaways for today: connect the dots between energy choices and business performance. Monetize energy solutions. What's in it for you, your business, your career? Okay? We're talking about the different ways of measuring value for different interests within an organization, from the shop floor all the way to the corporate suite. Everybody has a different way of measuring value. We'll talk about that. We talked about energy being a small portion of costs. Well, yeah, 3, 4, 5% of the budget, but energy is a huge part of the total cost of owning an asset. And I'm hoping now that you're seeing the pie charts on the slide here. We talked about comparing the cost of an energy improvement, some project with a 2-year payback, compared to the cost of all the energy and all the potential emissions and safety liabilities related to that energy consumption over the lifetime of the asset. We talked about the idea of the forced marriage between your facility and energy use. We talked about plowing some of the energy waste. You can intercept the energy waste within a facility and plow that money back into your income statement. And that's what this slide was covering. We talked about the idea of running the facility not as a cost center, but as an ATM machine. Now, we're talking about what happens if the energy we buy is used the way we want it to be used. The net effect is to create wealth. And the term I have for that is committed energy, the energy that behaves, if you will. Now, as we all know, some energy is wasted, and when energy is wasted, it doesn't simply dissipate into the atmosphere. It escapes through the assets that contain it, the steam mains, the compressed air lines, the heat exchangers, all the motor drives, the gears and bearings in those pumps, in the fans. When energy escapes, it escapes in the form of heat, friction, and chemical reactions. Think of the carbonic acid that forms in the condensate in steam lines. These are forces that destroy plant and equipment, and it creates potential liabilities, safety liabilities. There might be hazardous emissions liabilities. In total, this is the destruction of wealth. And the energy that is lost this way, this is just my term, I call it fugitive energy. But the takeaway here is that energy is always in motion. It's never in neutral. And the energy that doesn't create wealth is busy destroying it. Good thing to keep in mind. Now, let's look at a business process, and this is a very generic concept that I'm going to build on here. For any operation that you undertake, it will require some cash infusion up front. In our case, we're talking about spending money to buy fuel and power to create the heat, the pressure, the motive power to make our facilities run so that we have products to sell and, in the end of the day, make more money than what we put in at the beginning. Now, everybody knows that. Everybody also knows that that organization will have a finance or accounting professional of some sort who tracks the money at every stage, and that person has a variety of tools to do this. They use accounts, they use budgets, they use purchase orders. Okay. Now, on the energy side, there's a hands-on professional who also has some metrics at his or her disposal. Kilowatt hours, therms, pounds per square inch gauge, pounds per square inch atmosphere, steam pounds per hour, horsepower, cubic feet per minute, degrees Fahrenheit, just sharing these as an example. Okay. On the business side, the tools continue. We're all familiar with labor hours and rates and invoices, payables, expense reports, receivables, receipts, deposits, dividends, earnings per share. You don't have to remember all the details here. The point I want to make is this. Most organizations have an army of accountants and bookkeepers and people whose job it is to hunt you down to get a receipt for a $5 parking ticket or some minimal expense like that, but at the same time, they will get on their desk a bill for $50,000 worth of electricity every month, and they have no idea where that energy came from or where it went. The problem I have with this is we track money down to the penny. But why don't we track energy? There's value in it. It's worth doing. Now, let's talk about capital. Capital, just like energy, is always in motion. And capital is in motion through the economy. Our economy is nothing more than a collection of opportunities to invest, to grow capital to some amount larger than what it is now. Capital is always seeking a higher rate of return. Investors are trying to move capital from a place of low returns to a place of high returns. And any capital that doesn't achieve high returns is going to be lost in the form of expenses, interest, or inflation. Capital is never at rest, just like energy. Now, just like the economy, your business facility presents the same body of opportunities. Your facility is a small economy unto itself, and there are all kinds of opportunities to improve the rate of return on the invested capital that makes up your facility. Now, the investors who make your business possible, they have wealth inputs. They are seeking to get a greater amount of wealth from their investment. And just like before, if capital is not earning a greater rate of return, then it's being filtered out in the form of expenses, interest, or inflation. Now the question here is, who is going to get superior returns from your facility assets? The sticks, the bricks, the mortar, the equipment that represents your facility assets. Who is getting the rate of return on that? Is it your business or is it the utility company? Now, pursuing economic opportunity, 5-step process. Number 1, benchmark the current capital performance of your business, and we'll talk about this. Number 2, perceive opportunities to improve the performance, the investment performance of that capital. Once you have those opportunities scoped out, estimate the investment risk and return, reinvest your capital accordingly, and then start the process all over again. That's why we have annual capital budget cycles in most organizations. The process is the same for the economy as it is for the facility. The dynamics are the same. Now, all of a sudden, we've stopped talking about energy, and now we're talking about investments. And when the focus is investments, what do executives need to know? They need to know something about the magnitude of wealth created. That is the free cash flow. They want to know something about how fast that wealth is created. That's the rate of return. And they should be asking, what's the cost of doing nothing? Because if you ignore an energy improvement, you are, in fact, resigning yourself to energy waste and a negative cash flow related to that waste. So we're talking about investments and not projects. And why do I do this? I want to underscore this. When you go into your facility and talk to your colleagues and use the word project, it usually connotes to them some effort that's going to cost money. It's going to take up their time, and it's going to distract them from their operating goals and procedures. But when you use the word investment, we're talking now about something that produces a cash flow. It earns a rate of return, and it's a means for growing the business by creating wealth. A completely different message is being sent just from the choice of word. Now, here's our generic facility again. No matter what you do, your business can be described as a money-making machine. Okay? In this example, you've got 92 cents and a fraction worth of inputs which are converted into $1 worth of revenue. In this example, this is a business with an 8% rate of return on invested capital. Okay? This is a benchmark. This 8% is a benchmark because any additional investments that this facility wants to make, they should be getting at least an 8% rate of return on it or better in order to grow their business. Now, let's say that this facility is considering an energy improvement. And like most people, they look at the world in terms of simple payback. They want their investment to pay for itself in 2 years or strictly speaking, they want their budget to be replenished within 2 years, the cost of the investment to be replenished. Let's say, for this hypothetical, the energy improvement itself is $1 million investment. It provides annual energy savings, $250,000. Now, there's some financing going on here. Half of it is financed, and there's income taxes to consider. This is an investment with an economic life of 25 years. Do the simple payback. Pre-tax, it's 4 years. After you account for the depreciation, taxes, finance, the cash flow actually gives you an 8-year simple payback. Now, for the folks who want that 2-year threshold, obviously, they're probably going to reject it. Now, there's a relationship between simple payback and rate of return. Now, bear with me. Start on the upper left corner here. A 1-year payback, as you know, is a 100% rate of return. A 2-year payback is a 50% return. 3 years is 33%, and so on. Now, our hypothetical here, our company said they want a 2-year payback. What they're saying is they want a 50% rate of return on investment, and this is a measure without compounding the time value of money here. It's also interesting to note, remember that they had an 8% rate of return on their invested capital. If you measure that rate of return as a simple payback, that means the business itself has a 12.5-year payback on its invested capital. Okay? Now, what this provides is a dead band. There's a range between those two extremes. The investment dead band says that the investors will not invest in anything with a payback of more than 2 years or less than 12.5 years. There are good rates of return over and above 8% that could be gained from energy improvements, maybe some other kinds of improvements as well, but the business says no to them because they see the world not in terms of rates of return, but they're looking at the simple payback, and this is what's costing them. Now, here's our example again, the same hypothetical. I'm going to look at this a different way. Remember the $1 million investment, and it saves $250,000 per year for 25 years. The benchmark for this is the rate of return on currently invested capital, 8%, which you see here. I hope you see here on the screen. If you don't invest your new capital in the business, then where are you going to put it? You might put it in mutual funds. You might go to Vanguard and get an S&P 500 index fund, and you might make 3% on that. But 3% is not very attractive compared to the business itself. By the way, the cost to borrow might be 4%. Now, if you run the numbers on this, and I'm not going to bore you with all the calculations, so I ask you just to accept this on faith. When you run the numbers on this 25-year investment, the internal rate of return on a pre-tax basis is 25%. Now, if you do the same on a post-tax basis, it comes out to 12%. See, still better than the benchmark of 8%. And by the way, if you choose not to make the improvement, you're going to live with energy waste. And the internal rate of return, negative 12.6%, this describes what happens when you've got a lump sum for a potential investment and you say, no, I don't want to make that energy improvement. I want to sit on that capital. Well, that capital is going to be eroded over time by the tax-adjusted cash flow of money paid for the energy waste. And when you do the analysis on that, the internal rate of return is a negative 12.6%. That is the rate of capital destruction. You ask me, what capital is being destroyed? Your future retained earnings are a form of capital. If you are spending money on energy waste, it is at the direct expense of building retained earnings in the future. And by the way, just for laughs, I put on the scale where the 2-year payback of 50% would appear. Now, as I like to say to people, you cannot walk away from an energy efficiency investment proposal. Let's look at any energy system, lighting, boiler, air conditioning system. It doesn't matter what it is. Let this bar represent the total volume of energy consumed annually for that asset. Now, there's an opportunity to replace that asset with something that's more efficient, and it would only consume this much energy, the bar on the right. That volume is what I call the committed energy volume. And, of course, this implies an increment up on top. That's the volume at risk. Either you pay to avoid consuming that energy, that's the alternative on the right, or you do what you've always been doing, and you continue to buy energy and waste it. What I want people to understand is they're going to pay for that volume at risk either way. Money is going to come out of their pocket. There is no walk-away option here. Now, this requires a completely different way of looking at energy investments. You either accept it or you reject it. Let's read this from the top to the bottom. You either do it or you don't. Now, let's read on the left side. No matter what you do, you're going to get some measure of value, and you are going to give up some measure of value to get the result that you want. If you accept, let's go to the right side, if you accept the proposal to make the energy efficiency improvement, you will get the gross energy savings. And obviously, it's going to cost you something. It's the amortized project cost, the capital, plus all the carrying and interest costs that are rolled into it. If it's a good project, at the end of the day, there will be a net savings, a free cash flow, which you can put a dollar figure on. But if you reject it, you don't get any money. You don't get the gross energy savings, but you get, I suppose, the satisfaction of not having to do a project. Okay? What you're giving up is the cost of doing nothing. What is the cost of doing nothing? It's the gross energy savings minus the amortized project cost. That's the amount of money that you're leaving on the table. Think of that as a penalty for doing nothing. Before accepting or rejecting any kind of energy improvement, I recommend that it's useful to look at it this way. Now, this is an opportunity to change the paradigm for facilities management. Here's the old paradigm. And this is common. I've seen this across North America. Facilities is perceived as a cost center. Energy, to a lot of people, is just, it's a cost of doing business. Just use the stuff and then pay the bill. There's really nothing else to do. Facilities people have been clobbered over the past couple of decades. They have to do more with less. And you all know about downsizing and right-sizing and retrenchments and cutbacks and whatnot. This leads to a very, very conservative culture in facilities management. Many times I am told by people, well, we do it this way because that's the way we've always done it. Budget time means campaigning for the biggest budget that you can get, competing for those funds with other departments. And then once you have the budget, it means sitting on it for as long as you can and trying not to spend it. Interestingly, more than one person has told me that their success in facility management means not being noticed. The buzzword here, or the takeaway, is it's very understandable. It's very human. People are resistant to change. Now, the problem with this is change is going to happen anyway. We may not be the people who start change, but it's happening in the environment around us. And the opportunity, the risk or the opportunity, it's really up to us to decide which is which here. These are the forces acting upon us. We're trying not to change, but you know what? The energy markets remain volatile. and they change with every geopolitical incident that occurs every year, or any large weather incident. We're seeing the advent of smart grid technologies. That's happening around us, whether we like it or not. We're seeing always the evolving emissions and safety standards through OSHA, through the EPA. These are by law. We've got to stay on top of these. We see continuing interest from boards of directors and from consumers. They're interested in having green and sustainable markets for products and services. Okay, all of these forces are acting upon our organizations, whether we like it or not. So that leads us now to an alternative paradigm for facilities management. This is my suggestion. We can perceive facilities as not a cost center, but a profit center. And we do this by monetizing your energy position. A bit more on that in a second. This means getting some sort of pulse on the energy use in a facility, and having an energy audit which outlines the opportunities to improve that energy use. Instead of these reports collecting dust on a shelf, we're going to start putting them to use. We can redefine our measure of success in the facilities management space. Success now is predicated on the value that we create and demonstrate back to the balance of the organization. That success, that value it always boils down to money. It's a cash flow figure, the magnitude and rate of cash flow created. When we're doing this, we're future-proofing the business from those forces I was just talking about, those risks, the change that happens anyway. We want to be future-proofed against that. And when we as facility managers are doing that, we are protecting not just the organization, we're also future-proofing our jobs. Now, there's a great facility, a great tool available to you on the internet. It's made possible by Xcel Energy. Now, forgive me for saying it's great because I'm actually the person who built it for them. If you go to their website and click on the Save Money and Energy tab, and then on the Energy Audits and Studies tab, here's the Xcel Energy address, and here's your links, you're going to pull up something called the Energy at Risk Financial Analysis Tool. Now, they have been using this for several years now, and it's nothing more than a spreadsheet, an Excel spreadsheet that you download to your computer. And there's some videos on site there on this page, videos that you can download and watch, and those are your directions for how to use this tool to, in effect, monetize discrete energy investment proposals that you have right now on your desk. So I'm in the wrap-up stage here. I just wanted to share some ideas with you folks. With all due respect, I cannot tell you how to do your jobs. But I will say this, if you keep pushing the same buttons, you're going to keep getting the same results. So with that, again, I want to thank the folks at Fort Collins Utilities, Crystal and Kelly and many others there, and thank you folks for listening today.
So I am happy to introduce Kimberly Merrill.
I want to thank everyone here for having me because I think this is a really great, Chris's presentation was a perfect segue into what we're talking about because they've already done the introduction. So as I mentioned, Engineer Tax Services, we are an engineering firm and we have a very heavy tax background. So we're nationally licensed engineers across the country. We do approximately 250 to 300 studies per month. And I'll kind of get into detail about what these studies are. We are somewhere in the neighborhood of saving our clients between $24 and $30 million a month in tax savings. And Chris's presentation was fantastic because it talked about energy and what you can do and how important it is to maybe upgrade your systems or really evaluate what your businesses are using and how much you're expending. And we can take that one step further. And so I'm really glad that I trail his presentation for that reason, because we can just accentuate upon what he had talked about and the incentives that are available out there There's a huge push right now governmentally to really incentivize green. There's green building, there's LEED certifications, U.S. Green Building Council's really come into play. Energy Star, you guys, over the last decade, you've seen refrigerators and, microwaves and everything that's coming out, water heaters that are Energy Star. So what I'm here to explain to you, and I know sometimes when you hear engineering, it's, people glaze over, and then when you say tax, they glaze over. So what I'm going to try and do is bring this to you in layman's terms and help you to understand that if you have a building, or if you own a building, or that's part of your portfolio, that in itself can be a return on investment, as Chris said, in different ways. So I'll be able to kind of share those things with you. So what I'm here to talk to you about first and foremost is the Energy Policy Act of 2005. And if you haven't heard about this, it's also called the 179D. That's the tax code, or it's called EPACT. And a lot of people will say, I've heard about this, but I'm not sure what it is. I don't know how, I don't know how it works. And so I'm going to go ahead and explain to you how that works and how it gets incorporated into maybe some of the energy efficient upgrades that you do to your building. So the 179D, or the Energy Policy Act, was enacted back in 2005. It is on buildings that are placed in service from January 1st of 2006, and it currently expires at the end of this year. Why we're here is we want to educate you about it first and foremost, because you can go back in and achieve these deductions, but also we believe that this will be extended at the end of this year, and enhanced for that matter. So with that, the Energy Policy Act is an incentive for green building or green renovations. Now, when I say green, a lot of people think that they have to go spend a ton more money in order to achieve this green standard, and that's just not the case. The reason for that is because the code actually is based on a modeling from 2001 standards, okay? So 2001 standards, if you think about that, today we're in 2013. You've got 12 years of increased standards and energy efficiencies, the green, the Energy Star, all those types of things. And so therefore, it makes a big difference. Catching up, this deduction goes to private property owners, okay, or designers. I don't know how many people we have here that are architects or engineers or contractors in the community that are building or doing those types of products. But this calls for it's a deduction. Does everyone understand the difference between a credit and a deduction? They're two totally different things, and I know it gets a little bit confusing, but basically deductions come off of, they would be like an expense. So you have your income, and you get to deduct your expenses in your payroll and all those things. And then when you get to the net, you actually calculate your taxes based on that. And then credits are, you actually take your income and you have all your expenses, and you get to your net, and then you calculate your tax, what you owe in taxes, and then credits come off of that. So credits are like an actual payment that you made to the IRS, okay? And deductions are above in the expense column, okay, the expense line. So what we're talking about right now are deductions, okay? So they're valuable, but it's not the same as a credit, okay? Credits are different. So the 179D would be eligible to any upgrades or renovations or retrofits, okay? And now we're going to talk about 3 different components of your building. So if you own a building, you're going to have HVAC, lighting, and building envelope. Those are the 3 biggest contributors and users of energy. Lighting being number 1. Lighting actually is a 40% usage of your total consumption of your energy. Lighting is the biggest, okay? 40% overall. And then you have your mechanical, and then you have your building envelope. And we'll talk about what those things mean. So if you do any upgrades, renovations, or retrofits to those 3 components, you could be eligible for this $1.80 per square foot. Okay, and we'll go into how to calculate that. This is good on commercial buildings, so facilities, if you have hotels or hospitals, but basically any commercial building out there. Office buildings are great. or residential. So if you have residential buildings that are maybe dormitories or apartment complexes or whatnot that are 4 stories or more, it needs to be a little bit larger of a residential building, but those can qualify for this as well. On the screen, it shows us LEED certified buildings. Those are a candidate. And just make sure that you know those are a candidate. It's not mandatory. You don't have to have a LEED certified building in order to qualify for this deduction. But it's green on the screen because it's about a 95% chance that you will get the entire $1.80. All right. Green or energy efficient buildings. So just because you build a building and maybe you didn't put forth more upgrades or whatnot just to be quote unquote green, but maybe a lot of times what you don't realize is that just by doing it based on the new technology that has come out here, even in the last 4 or 5 years, you could qualify for that because we're comparing it to such older standards, the 2001 standards. And then like I said, if it's a green building, it doesn't have to be LEED certified, and it doesn't mean that it will or it won't. Okay, so it's a candidate if it's a commercial building that you've done any kind of, it's new construction, it's a no-brainer. If it's retrofits, it's definitely something that you want to look into for being a candidate for this. Types of buildings, like on the screen, we show schools, government, office, retail. We have parking garages, industrial, manufacturing, healthcare is huge. There's 3 different methods for obtaining, okay? So the IRS requires that there's an engineering study that needs to be done, or a certification rather, on the building in order to confirm and make sure that you meet the requirements that they set forth. So the IRS says that we want to reduce overall energy consumption by 50% over the 2001 ASHRAE standards. Okay, so this is where that older study comes in. Now this is the ASHRAE 90.1, and it's Appendix G standards. So as you can see, what they do is they say, okay, well, if the whole building qualifies for the 50% reduction, you get $1.80 a square foot as a deduction. Okay, so we actually put a threshold on that. If your building's less than 20,000 square feet, it may be a little bit too small. So we're talking about a little bit larger facilities, 20,000 square feet or more. It would probably be economic for you to move forward and pursue these types of deductions and the certification. So what they're saying is you can break this down. There's several different components to it. So you can get the $1.80, but let's just say you go out and you do just the lighting renovations in your building. You replaced all the lighting, make it, you kind of took Chris's promptings and you said, let's go renovate our lighting system because that's our biggest user of energy. You could qualify for a portion of this deduction, a portion of the $1.80. And all we need to do is hit a 16 2/3% reduction in energy just in your lighting, and you would be eligible for 60 cents. So there's a couple of different, this is a little bit confusing on this slide because it does break it down and compartmentalize it, and they have changed the tax code over the couple of years. So 2006, it was an easy 16 2/3 across the board, which, by the way, is your 50% divided by 3, so that's where they get that. And then then in 2008, they actually changed it because they saw that lighting was coming back with such high, lighting industry, you guys, if you own a building and you haven't replaced lighting in the past 10 years, you are literally losing money because the return on investment is most likely less than 2 years, what Chris was talking about, but can be much more than that when you include and put together those incentives along with the taxes and other rebates that are out there. So in 2008, they made it better, and then in 2012, they even came back in and made it better, which means that, and let's just jump down to the 2012 notice, what the IRS came back in and said, if you hit 25% reduction in energy usage in your building after a certain date, then you only have to reflect a 15% reduction in HVAC and a 10% reduction in building envelope. Now, the reason they did that was because building envelope was the hardest to achieve. And the lighting advancements, we were seeing, literally I have seen lighting projects come back on its own a 50% reduction. So a client would come or, they would go and renovate their lighting, and when we would model the building to see, literally the lighting alone came back at what the requirements were. So they were able to get the entire $1.80 and basically not even trying, okay? So It's just the advancements that we're dealing with today. So it's really not as hard as you think it is to achieve the $1.80. We just need to have the engineering study in order to back it up and certify it. So the whole building approach, you get the $1.80 if it reduces at 50%. Then it breaks it down into the 3 different categories. If the entire building, or if you just did a renovation and you just renovated maybe HVAC and lighting, you didn't touch the building envelope, then you have the ability to get 2 of the 3. So you would get it 60 cents for one, 60 cents for the other. That's $1.20 as your deduction, okay? And that's where we come in. The engineers will come in and certify that and tell you exactly where you lie and what your deductions will be. You take that report, you give it to your CPA, okay? It's as simple as that. They file the taxes. Your HVAC in your building envelope, they either qualify or they don't. So it's your entire 60 cents or 0, okay? So we do a really nice pre-qualification to make sure that you're going to qualify before we ever go into the engineering part of it, all right? We don't want to do an engineering study and have you lose money, obviously. The lighting is the exception to the rule. Again, lighting is just out there. It's just phenomenal, the technological advancements. In fact, there's a statistic out that says that you can successfully replace your lighting every 5 years and it pays for itself. It literally pays for itself. And that's with the energy savings, the rebates, and those types of things. And I'll show you how to even take that one step further. But the lighting is special because there's interim rules. So you can actually qualify for a portion of that 60 cents. And this is the only component of the building that you can qualify for less than the 60 cents. So I'm going to show you a couple of case studies. This is a grocery store chain. They had four facilities, and as you can see in the middle column where it says 179D per square foot, the San Jose and the Modesto, they qualified for 2 of the 3 systems. That's where they got the $1.20. And then the Petaluma and Sparks, it was $1.10. So they got 60 cents for HVAC and 50 cents for lighting, okay? So that's where those interim rules kicked in, or the halfway mark for the lighting systems. And these were $290,000 in deductions, which equated, by the way, to approximately $100,000 in cash. Okay, so you tie that to the return on investment, you start incorporating that into the savings and what they spent on the lighting systems, and now the return on investment is way better than it was had they not pursued the 179D. Here's another case study. That's a car dealership. Car dealerships, you know, they could be anywhere from 20 to 40,000 square feet, depending on the size. But this one is a smaller one out of Montana that they achieved 35,000, and this kind of segues just a little bit into, you know, talking about abandonment, because when you go in to renovate your lighting system, you're taking out the old, and there are also additional tax incentives for that as well. A lot of people don't realize that, so we'll talk about that. And what happened with this particular study, we also did a cost seg and abandonment for them, and it equated to about $640,000 in deductions over 5 years. And I'll show you how that works. Now, when I talked about the 179D, I said this is good for property owners. There is an exception to that rule. And I'm going to separate this just a little bit because this gets a little bit confusing, so I don't want to muddy the waters. But if the building that had the renovations or this new construction was government owned, okay, a city building, county building, state building, federal building, anything that's government, could be special districts, could be, you know, firehouses, libraries, schools. Then this deduction, then, because the entities, the governmental entities are tax exempt, they don't pay tax, obviously, they can't utilize a tax deduction. So when the IRS wrote this code and they put this in place, they made an exception to this rule. And that is that if it is a government-owned property and you're doing design, renovation, if you do energy upgrades, if you're working on this building from that standpoint, and you're going to designing these systems, then you could have that governmental agency allocate the deduction to your firm. So this could be architects, could be engineers, it could be contractors, it could be energy consultants, anyone who worked on that building and helped write the technical specs surrounding the lighting, the HVAC, or the building envelope. They then can take that deduction themselves if it's allocated over to them. Now, you guys, this is awesome because what happens is there's money that's being allocated at the federal level to, you know, disperse down into the states. And, you know, we have a lot of governmental agencies that, you know, will say, well, why would we want to, you know, sign this over to you? You're getting something. We've already paid you for this project, blah, blah, blah. But really the mentality, instead of being very selfish about it, is broad. And what we should be looking at it is the fact that, let's say a school does, they build a new school. I mean, you guys, there's tons of schools. Those of you who have kids have seen the improvements that they have done to schools. It's just crazy across the board, every school in America. These deductions get to go back to the designers of those schools, architects or engineers. Well, what happens now is we're actually taking the money from the hands of the federal government, we're bringing it back into our local communities. Whereas if this was a government building and they didn't allocate these funds, those funds would stay in the hands of the federal government. This is a way for us to increase our economy locally. This is a great way. Governors all over the country are getting involved and mandating that these allocation letters should be signed. Sign these over to our designers. Let them have these, because that's the way the tax code has been written. And that's indeed what happened in this case for schools. This was BLRB Architects that we've been working with since the inception of this in 2006, and they qualified for, you know, enormous amount of deductions, $292,000, and they don't even own the building. But how cool is it that they got to bring that back into their local communities? Many, many, many of these architects are taking that money and donating it back into their communities. So that's something that we really want to promote. This is an office building, and this, when I said that parking garages can qualify for this, well, maybe if you were thinking about it, HVAC and building envelope, there's really no parts of that in a parking garage. But there is lighting. So the lighting can qualify in parking garages as long as it's covered. So if you have maybe a parking garage with the top that's exposed, the top square footage would obviously not be included in this deduction, but all of the lower layers below would. So in this case, where you have the building and the parking garage underneath it, they qualified for a total of 220,000 square feet at the $1.80, and then the other two, they qualified for HVAC and building envelope. Okay, so building envelope being roof, insulation, windows, doors, anything having to do with the shell of your building. And so, you know, simple measures to improve your exterior. Even window films can affect the shading coefficients. There's tons of improvements that have come around with just simple window tinting. Here are a couple other architects who've utilized these deductions year over year. And literally this could mean the life of these firms. There are many, many firms who really just focus on governmental projects, and they're heavily involved in their communities that way, building schools, building libraries, higher education. And this was, you know, a lot of the ones who were involved in the governmental projects who have pursued the 179D have stayed in business and stayed strong, which again contributes to our local communities. So these are, you know, some dollars, you know, millions of dollars. So the IRS reports that less than 3% of eligible taxpayers, and this is eligible, you guys, eligible, which means that if you did improvements, most likely they would qualify. You could be eligible for this, or you would be eligible for this. Only 3% are actually filing and taking advantage of the 179D. This is one of the reasons why we fully anticipate this to be extended after this year. And they're also talking about enhancing it. They're actually talking about raising it to $4 a square foot as a deduction instead of just $1.80. So this is really important. You can go back and achieve these. So if you are the building owner, you can go back all the way to 2006. Had you done improvements to that building back then, you can still go back in and file, get your engineering study to confirm it, and put that on your taxes without having to amend. That's key. You can bring it forth. It's called a 3115. It's a change of accounting method, and the IRS does allow that method to bring forth those deductions. If you are if it's being allocated to you by the government, then you actually have to stick to the 3-year look back. So you can, and you do have to amend taxes. So there's a little bit of difference there. If you're questionable or not sure, just contact us and let us know, and we'll help you through that. Any building with lighting and HVAC systems that are 10 years old or older is outdated technology. The energy efficient lighting and HVAC can save over 50% on your 20% on your electric bills, over 50% on your usage. You guys, if you have buildings and you own buildings, or you're working for a company that owns the building and you have outdated technology, I would urge you to really start to look at what that's costing you, because just like Chris said, it is costing you money to have outdated technology. The technological advancements are absolutely just incredible right now. You couple that with the improvements, the savings, the investments, the rebates that come, and the tax incentives, or the tax availability that's out there. It's just a no-brainer. The return on investment, Chris was talking about a 2-year payback. We have seen that most lighting companies will come and they'll do an audit, and then they'll present to you a package deal. This will give you a 2.5 year return on investment or whatnot. When we couple that with abandonment, and we couple that with incentives, we actually will show that the return on investment, we've seen them as low as 8 to 9 months. Okay, so we talk about people want to see a 2-year. You couple these together, and it's just incredible. This is a copy of an allocation letter, but I'm not going to go over that. So along with what Chris said, this slide is really important. This is the Desire website, and this is a nationwide website that you can use. You go click on your state, and it will tell you every single solitary energy efficient incentive, whether it's a local rebate, a state incentive, loan programs, grants, or federal savings that are out there, okay, for anything that you do. So I would urge you all to use this. It's Desire, SIRE, USA.org. And it's constantly being updated. So if you're not using this, please go to it, because it really does list some great incentives that you can really couple. And many of your energy efficient consultants or your lighting companies don't even know about how to bring all this stuff together as one big package. A couple of things before I wrap up, because obviously we're not going to get too much further into this, but the IRS code states that the certifying parties, they must be qualified individuals. They have to be third party and unrelated to the building, so that's where you need to hire an exterior engineering firm to come in and certify your building and model the building in order to achieve these deductions. So please make sure that you're using somebody who's qualified. There are a lot of local engineers who are trying to add profit centers, and I would make sure that you know that a lot of those engineers do not understand tax code. This is a tax code, okay? So please, whether you use our company or use a different company, please do your due diligence, because not only are you going to be putting yourselves at risk, but you will be putting your CPAs at risk, because if they sign off on that tax return and that is wrong, they could be penalized for it as well. So all I want to leave with you is that if you want to pursue this, please make sure that you have a qualified individual that can do it, and just an engineering firm isn't going to cut it. They really need to understand tax code and tax law. One last slide that I want to leave with you, and then I'll be done, is that I talked about the abandonment and how when you take out the lighting systems from your building, you guys, there's what we call depreciation, and I know some of you may understand of this and some of you may not. But when you have a building, you actually put a building on a 39-year class life, and you depreciate that building every year by 1/39 until it's fully depreciated. What happens when you take systems out, like HVAC or lighting, that is still being left on the depreciation schedules unless you do what we call a cost segregation study. Now what happens is, and this adds to the benefit, we start out with an $80,000 lighting system that's 10 years old in a 60,000 square foot building, okay? And that depreciates to the rate of $2,051 every year for 39 years. So what happens if it's 10 years old is you've already depreciated $20,510, okay, of that amount. And then you come in, and when you take that out, that $80,000 investment, you've already depreciated $20,000. That means there's $60,000 worth of depreciation still on the books. If you haven't broken that down initially before you take that lighting system out, you will continue to depreciate that $59,000 over the remaining 29 years. okay, even though you don't even have that system in your building. So and I will tell you this too, a lot of you think that, well, my CPA does this for me. Well, I will tell you, I work with CPAs every single day who don't do this, okay? They just stick your building on a 39-year class life and they call it good. You need to do a cost segregation study, because as you go and rotate these improvements out of your building, you need to be taking them off of your books. This is money in your pocket. So what happens when you apply this, so you come down this line with the 60,000 times 60 cents. This is just the lighting renovation. That 179D is 36,000. So when you couple your EPAC deduction for 36,000, and then we came in and did an evaluation on your lighting system to give it a value, we were able to deduct another $59,000 for a total benefit of $95,000. That equates to about $30,000 in cash that now just went back up into the new investment. You can't tell me that that's not going to increase your return on investment when you do a lighting system. This doesn't even take into account at all your energy savings, your utility rebates, nothing. So you virtually can get the lighting system actually paid for by the government. These are the incentives out here. And this is my job, is to basically bring this to you and bring you the awareness and the education that if you have a system that's 10 years old or older, your return on investment can be less than 1 year to do these energy improvements. So I'm going to stop and turn the time back over to these guys. I know we didn't get through a lot of it, but I think this abandonment piece is the biggest part, because as you can see, it's as valuable, if not more valuable, than just the 179D itself. When you couple the two together, you can have just incredible incentives. So thank you, and I'll turn the time back over.
Thank you so much. And also, just as a reminder, the full presentations will be available online afterwards at that fcgov.com/BizEd. So thank you so much, Kimberly. Next up, we have Matthew Brown to talk about financing efficiency improvements.
Well, it's a pleasure to be here. Yeah, I drove up from Denver this morning, so I'm wide awake after a couple cups of coffee. So what I'm going to do is talk about financing and financing options, and kind of how financial institutions tend to look at energy efficiency in particular. I want to kind of start out, and I think actually the first two presentations have been great, and kind of the initial kind of stage setting, and then looking at some of the tax advantage. I think that was a terrific kind of setup, because now the question is, I guess if you kind of look at the presentations, number one is, why should you do this? It's kind of interesting when you look, Kimberly, what was it, 3% of the people, the eligible taxpayers, have taken advantage of these tax benefits. I'm not sure what the numbers look like for broadly in the Platte River Power Authority area, or in Fort Collins in particular, but typically what we see is a lot of our clients, a lot of the utilities that we work with, will see uptake of 1, 2, 3, 4% of eligible eligible members of a particular class might be using the rebates that are available to them. So I mean, there's a lot out there. There's a lot of rebates from utilities. There's a lot of tax incentives out there. So why is it that that people don't just jump all over this, right? It's financially, it's the logical thing to do. It's kind of an interesting, kind of just general question. Well, we think about this a lot, because what we do is we try to provide one additional tool, and what our firm does, we work with utilities, financial institutions, governments around the country, designing financing programs. So it's kind of one additional tool. So why don't just people jump all over this? Well, it's interesting. You think about it. When you start up a new business or move into a new facility, you need power. Well, what do you do to get that power? You call up the electric company or the gas company. That's all you have to do. Now let's say that you want to install efficiency. Well, there's a whole series of steps you've got to go through. You have to figure out what equipment you're going to install. You have to bring in contractors. You have to take time to do that. You have to find money because this costs money. You have to manage an installation process, and there are risks that you have to take. Installing energy efficiency, frankly, isn't easy, and I think it's by no means as easy as just as simply to call up the electric company. One of the things that we look at when we think about financing is how do you make it easy? How do you recruit partners who are experienced in actually making that whole financing process, which is one additional element of all of this. After you've taken advantage of all the tax benefits that you can, how can you make it easy? And because in the end, what financing does is even after you've taken advantage of utility rebates, even after you've kind of done that analysis and then you've said, as Christopher was pointing out, you've got all these wonderful energy savings. There's still a first cost that you've got to deal with, and so financing actually eliminates that first cost. Financing usually, still isn't necessarily easy, but it takes you one further step. So it's an important part. A question actually within the folks in the room, because I don't exactly know who we're talking to, but how many of you, at least within the room, and I won't. It's impossible for those on the webinar to raise their hands, but how many of you are in properties that you actually own and operate versus in lease? So, and leased properties. So okay. So actually, we've got a good number of kind of owner-occupied properties. So there's kind of two buckets when you look at when you start to look at financing. Frankly, from a financing perspective, typically the harder properties to finance are the investor-owned properties. Owner-occupied can tend to be a little bit easier because the benefits can be better aligned with the party that is actually paying for the financing. And actually, from a financing perspective, it's amazing when you start to look. You go into a large commercial building in a downtown area, and you try to identify who actually owns that building. It's typically a very complex limited liability corporation that is it has multiple owners, and it's defining the credit even that you can evaluate is actually quite challenging. So owner occupied is often a little bit easier. So another kind of big picture, why is it that commercial buildings don't tend to invest in energy efficiency? A lot of it, and this is kind of focusing on the money side of it. JCI did a study a few years back, 3,000 commercial properties, and a lot of the barriers come down to kind of the ways that companies manage their capital. And the risks that come about from making that first investment. So a lot of this ties into, even after you've identified the tax advantages and the energy savings benefit, there's still a number of barriers that financing really starts to address. So that's kind of the big picture. Why is it that we even want to look at financing? And by the way, I think this is the other kind of big picture thing before we kind of get into some of the financial instruments and options. What we find, I'm guessing that none of you in the room particularly think of yourselves as being in the energy business. Energy is a cost. You want to manage that cost. And what we've found is that typically people want to manage energy cost, but if they're going to take on debt, they're typically going to take on debt for kind of their core business activity. And I don't know whether that resonates. See a couple nodding heads. But so why we have to kind of manage any type of financing structure around that. What we see are kind of three types of financial instruments that are typically used. One is debt. The most common is debt. Unsecured loans, are one type of instrument we see, and we see secured loans or secured instruments. I'll spend just a second on the second sub-bullet of under secured. This year, a few weeks ago actually, the governor signed a piece of legislation here in Colorado that enables a form of financing called PACE, or Property Assessed Clean Energy. Property Assessed Clean Energy is a new type of financing whereby a lender essentially makes a loan to a property owner for a qualified energy efficiency investment, or it could be a renewable energy investment. And then that property owner pays back that loan through the property tax. So from the perspective of an investor, what that means is that the security of that property tax payment is actually very strong. It's among the strongest types of security that you can get. So you actually get very good terms from investors, and you get investors who are providing money for the kinds of investments in energy efficiency that they might not otherwise, they might not put up capital for otherwise. So from an investor perspective, it's quite attractive. What's interesting is in a multi-tenant facility, because this is a property tax, in a typical lease, you can actually pass through any property taxes in a typical lease through to tenants. So from an owner perspective, it can be a good thing. Secondly, the type of financing that's available through this is typically 15 or 20-year financing. It's very long term, so you can actually amortize if you've got a pick any size investment, $1 million investment in energy efficiency, very large investment, or a $100,000 investment in energy efficiency. You're amortizing that investment over a much longer time period than you typically would be able to amortize, say a 3 or 5 year investment. So you can then match your energy savings typically to the annual or monthly or semi-annual financing costs that you've got. So it's a very interesting brand new kind of financing mechanism that actually has not rolled out yet, but we're going to start to see it in Colorado, probably starting around the end of the year. A second type of financing is leases, and I'll spend a couple minutes talking about a leased option that's developing in Colorado that's here, that's designed specifically for energy efficiency. And then finally, on-bill financing. Fort Collins Utilities has an on-bill financing product available in the residential sector. A number of states that we work with around the country have on-bill financing available for commercial property owners. It's not available at this point in Colorado really anywhere. So I'm not going to really spend a lot of time on it, but basically I referred to a kind of to PACE, where the loan is paid back through the property tax bill. In this case, with on-bill financing, the loan is paid back through the utility bill. And very often there's, much like when you don't pay your energy charge, you're subject to disconnection. Very often, if you don't pay the financing charge, you might also be subject to disconnection. So from an investor standpoint, it's attractive. From a consumer standpoint, it's a lot easier. You often get better terms than is otherwise available. Not going to spend a lot of time on that because it's not available here in Colorado at the moment. First question that you always have to answer in financing is what type of credit are you? The easiest credits to get financed are going to be rated credits. My guess is that probably none of the folks in this room are going to be large enough companies that where you've got a rated credit. Typically, when a financial institution looks at credit, they're going to look at they're going to talk about an A, B, or C credit, tier 1, tier 2, tier 3 credit. And essentially what's going to happen is as you get further down into the credit stack, into an A, a B, or a C credit, you're going to be asked for more documentation. You're going to be asked for, in some cases, particularly with a small business, that business is asked not only for the business's financial records, but also for a personal financial guarantee as well. So it really, you get into a place where financial institutions they don't make as much of a distinction between the business itself and the owners, the principals of that business. So I suppose if you look at this graphic, you start to understand why I keep coming back to the idea of trying to get this simple. And in fact, this isn't as easy as calling up your electric company to get the power turned on, right? So I mean, this probably says it all right there. But I think the point is there are, first of all, multiple parties involved: contractors, the utility, property owners, lenders, and so on. The point is that there actually are some. And even developing here in Colorado, there are a number of options that are actually kind of taking a lot of this and making it a lot easier from a customer-facing perspective, making it a lot easier to deal with this all this stuff to provide the financing going on in the background. So I want to mention two programs in particular. One is currently only available in Boulder County and Denver County. It's available through Elevations Credit Union, and it's been around about 8 months or so. There was about a roughly $20 million grant that was provided to Boulder County and Denver County that was used. Part of it was used to bring in as a partner Elevations Credit Union, which is making both residential and commercial loans. So these are unsecured and secured typical credit union loans to commercial property owners for energy efficiency retrofits. The second one I'll spend a minute talking about is a lease product. This lease product is actually being developed right now primarily in the Excel territory. Now, I know there's overlap on the gas side often between Excel territory and the electric territory of folks in this room. So first off, Elevations. Basically, kind of the background here is that there was this large grant, federal money, that was made available to basically backstop some of these loans. That means that the lender, Elevations Credit Union, was willing to essentially extend the terms of loans, extend the duration of these loans, and offer a lower rate than they otherwise would do. So there's a bunch of approved energy efficiency measures for which this can be made. There is and you can see that you've got rates that are actually starting at a quite low level, and with terms potentially going out as long as 120 months. That's a very long term loan for commercial. That's a very long-term commercial loan. I think that typically what you're going to see in the marketplace are going to be loans that are going to be from 2 to 5 years. So this is one product that's out in the marketplace. Another one, and I know you're well, this actually maybe isn't too bad. This is a lease product that's available. Now the difference between a lease and a loan, I think the main thing that I want to emphasize here is when we're talking about a lease product, people tend to worry about, well, who owns equipment. It gets. I think people focus sometimes on kind of saying, well, I don't really understand what a lease is. Frankly, a lease in this case is frankly, it's a loan with a different type of investor and with a different kind of application process, an easier application process. So typically, what you'll find with This particular lease product, there's a very easy kind of one-page application process. There's a very fast turnaround, so it's a typical turnaround or approval is going to be anywhere from minutes to just a few hours for this lease product. So to me, actually, a product like this, a financial product like this that is being developed is actually quite appropriate for the type of smaller energy efficiency retrofits that I think you're going to see a whole bunch of. It's fast, it's easy. The rates may not be quite as good as that Elevations energy loan, but it's in terms of kind of meeting that simplicity test that I was kind of started out with. I think it does a good job of doing that. This one, by the way, it talks about lighting retrofit financing. This is kind of a sample of what a flyer looks like. This has actually just been launched within even the last few weeks in Colorado. So even some of the application forms are still being built. So again, we've kind of talked about three types of financing. One is kind of on the horizon. This is PACE, Property Assessed Clean Energy. I guess I would say stay tuned on that one. I think that's going to be a very interesting product. We're going to be working with the Colorado Energy Office over the course of the next several months to roll that out. I think we're hoping to be working also in partnership with a number of utilities in the state to partner in actually rolling that out. Secondly, we've talked about loans. There's unsecured and secured loans, in particular the loan product from Elevations that's available, and that may be offered on a more statewide basis. And third is the commercial lease product. I think what you're going to see is over the course of the next 3 to 12 months, you're going to start to see a lot more of these kind of very energy efficiency focused financing products become available, some of which are going to be available for they're going to be appropriate for much larger projects, some of which are going to be appropriate for much smaller projects, different types of markets, and so on. But I think you're going to see a lot of evolution, and I think, as you can kind of tell, even as I'm talking about things that are, where legislation has been passed and it's just on the horizon, or things that have been launched in the past 3 weeks, or things that have been launched in the past 6 to 9 months. This is a very fast evolving field. It's quite an exciting field. We work, as I say, all over the country, but happen to be based here in Denver, so it's always kind of fun for us to be actually able to do something here where we can drive to work with folks on this. So that is what I've got, and I think we're almost on time. So thanks.
Thanks so much. We're going to go ahead and move on to the question portion. For those of you who can stay, for those of you who can't stay, we'll be actually pushing out the questions as well as the answers and a couple of follow-up videos on June 26th. But we'll go ahead and look through some of those questions again if you're able to stay. So the first one that we have, perhaps maybe the only one that we have, is how does tax-exempt operation access benefits of Energy Policy Act of 2005? So that's Kimberly.
Okay, to answer that question, tax-exempt, so like not-for-profit, I would assume, don't really fall into the EPACT category at all. So if you're not-for-profit, they're not taxable, and they can't utilize it, and they cannot allocate it. But if they're tax-exempt, meaning governmental, then as I explained, they can allocate it over. So they were inadvertently not-for-profits were kind of left out of the tax code for the Energy Policy Act. And in the new proposals moving forward, the one that raises it to $4, it's $4 for renovations and $3 for new construction. And if it passes, they're allowing the allocations to go to and from anyone. It doesn't necessarily have to be a governmental agency. It could even be a private. If it passes, they can allocate it to whoever. So I think there's going to open up a whole new industry as far as those types of things. But a not-for-profit, then, if it passes, we'll know at the end of the year. If it passes, then they would be eligible to allocate it over to somebody even though they can't use it. So hopefully that answers that question.
So for any additional questions that people may have as you go back and kind of let this start to percolate, we will, you can contact your representative at utilities, whether that be through ClimateWise, through one of your account representatives, through Kelly Gonzalez, and we will make sure that we get those questions to Christopher, Kimberly, or Matthew. We so appreciate everyone's patience today as we kind of stepped through this new way of doing our BizEd series. I think they were 3 really great presenters and excellent information. And again, it's going to be available to everyone to view afterwards at our website, fcgov.com/BizEd. Many thanks to the presenters today. Thank you all to the participants for participating and for your patience. So thank you.